Welcome back to the deep dive. This is where we try to cut through the noise and bring you some high value, specialized insights. And today we're looking at something pretty unique, the proprietary Loop Market Weekly Recap. This is for the week of September 22nd to the 26th, 2025. It's authored by Devin McClarty, powered by D Investment Enterprise, LLC. So, yeah, definitely proprietary stuff here. Our goal today is to really take this high level analysis and pull out the key theme, which seems to be this major split in market action that, well, it defined the whole week. We saw this real polarity emerge, and figuring out what that means is, I think, crucial for navigating what's coming next.
Okay, let's unpack this.
Yeah, the report really starts by drawing a clear line. It says this wasn't a week where the market, moved all together with conviction. Not at all. Instead, what we saw was this profound divergence. You had defensive sectors, the ones that are usually seen as safer, maybe a bit boring. They were the only ones really posting meaningful gains. Meanwhile, technology, the growth engine, it actually gave back some of its momentum. So the core question this analysis raises is, was this just healthy rotation, like investors shuffling funds around? Or is it hinting at something maybe deeper, like fragility or even fear?
Right. And for you listening, understanding the split isn't just theoretical. I mean, when market pros, like the analysts at D Investment Enterprise, pinpoint this kind of shift in sentiment, it really impacts strategic positioning. Getting this right helps manage risk, helps find opportunity, especially if things get choppy. So let's start with the big picture, the indices, segment one. The top line numbers, they seem kind of confusing at first glance.
Oh, absolutely. Mixed signals all over the place. The bullish perspective, highlighted in the recap, points to resilience. The Dow Jones finished slightly positive. The S&P 500 was almost flat for the week. So the argument goes, this shows investors weren't just running for the exits. They were just maybe moving money into safer spots, specifically financials and consumer staples, and maybe taking some profits in tech after that strong summer it had. Makes sense, right?
Okay, but then there's the NASDAQ. That's the big question mark here. It slipped quite a bit. If the growth sectors, primarily tech, are sputtering, how can the overall market feel strong? That's where the caution comes in.
Exactly. That's the counterargument. You really can't ignore the weakness shown by that NASDAQ pullback. Technology isn't just a sector. It's often the main driver of market breadth and, frankly, confidence. So if that engine is slowing down and you see mixed breadth across the market, meaning not everything is going up together, it suggests capital isn't feeling all that confident across the board.
I want to zero in on that conflict for a second. Why would the cautious view see defensive rotation specifically as fear? If I'm just moving money from, say, high-flying tech stocks into dividend-paying staples, isn't that just prudent portfolio management? Shifting risk?
It could be just that. But the key distinction the analysis points to is the pace and the selectivity of the move. When money moves really decisively, almost rushing into sectors like staples and financials, well, the cautious interpretation is that investors might be bracing for something worse. Stops looking like simple rebalancing and starts looking more like a flight to quality, which implies, a higher perception of risk out there. It suggests maybe they think the growth run is over, at least for now. So the prevailing narrative that McClarty's team identified this week was definitely this decisive rotation, capital moving out of aggressive growth into defense. They actually called it selective safety seeking.
Selective safety seeking. That's a telling phrase. It implies investors were actively looking for places to sort of hide their capital, but without pulling out of the market entirely. Okay, so where did this hiding capital go? Let's move to segment two and look at the sector heat map details. Where was this smart money finding shelter?
Well, the heat map makes it pretty clear. Consumer staples and financials were the obvious leaders, big inflows there, which really backs up that safety-seeking idea. For staples, the thinking is they're resilient against inflation fears. Demand is stable, reliable, you know the drill. And financials, well, they often benefit from a stabilizing rate outlook, and their valuations looked maybe a bit more reasonable compared to tech at that point.
So the boring stocks suddenly became attractive again. What about the other sectors? The middle ground?
Yeah, the middle sectors think healthcare, industrials, energy, they were mostly sideways, kind of neutral. Didn't see aggressive buying, but didn't see panic selling either. It suggests investors in those areas were sort of holding their breath, waiting for a clearer signal on direction, not yet convinced if this rotation is temporary or something more significant.
And then the weakness, that was concentrated, was it?
Oh, yes. Technology and consumer discretionary. They were the clear laggards. And the really critical point from the proprietary analysis is this. A market generally can't sustain a strong bull run if the growth sectors aren't leading. If it's only the defensive names, like staples and financials, going up,
Mhm.
well, the market's overall potential feels capped. It signals caution deep down, even if the main index numbers look okay. It's a classic sign of market malaise, really.
That makes a lot of sense. Grounding it like that helps. Okay, let's get more specific now. In segment 3, we should look at the individual stocks mentioned in the financial engine watch list. Because these names, these 4 stocks, they really seem to capture the polarity we're talking about.
Yeah, they're like little case studies in real time. The proprietary system uses metrics like beat streaks that's outperforming an internal benchmark and territory defined by the profit zone to track momentum. So let's take 4 key stocks mentioned and see how the bullish idea and the more bearish reality clashed.
Okay, start us off with RCI. What did the system flag there?
So RCI, it logged what the report described as a historic 14-day beat streak, 14 consecutive days of outperforming its benchmark. That's signaling really strong momentum, and the bullish take definitely celebrated that run.
Wow, 14 days is huge, especially in a mixed market like that. So what's the catch? Where's the counterargument?
The catch is quality. The cautious analysts flagged it immediately. They noted the streak happened on thin volume. And we have to understand that. Momentum's great, sure, but if hardly anyone is trading the stock that's low volume, it's kind of like winning a race with no spectators. These long streaks on low volume, they can be really fragile. They often snap back hard when real volume returns. Makes the momentum look questionable, maybe prone to a reversal.
Right, high momentum but low quality participation. That sounds like a potential volatility trap, especially if the broader market's nervous. Okay, next up, WU, another financial name, probably benefited from that rotation.
Yes, WU showed signs of recovery with a 3-day beat streak. The bulls saw this as, proof that money was flowing back into parts of the financial sector.
Mhm.
Rotation working as expected. However, the more cautious view reminded everyone that WU overall is still considered a lagging name within financials. So a short-term bounce is nice, but doesn't necessarily erase the longer-term weakness that was there before. Good sign of rotation, yes, but maybe not a signal of a fundamental turnaround yet.
And HSY, Hershey. That's a classic staple.
Mhm.
Clearly fit the defensive flow narrative. What did the internal analysis find?
Yeah, HSY, textbook consumer staple. It broke a pretty long 9-day lag streak flag, meaning underperforming its benchmark, and had a noticeable breakout. And this move seemed driven almost entirely by those defensive capital flows we discussed, just a clear rotation play. So the bullish side pointed to it as evidence that, yes, the defensive strategy was the right call for the week.
But again, I assume the cautious analysts put that in context.
They did. The critical footnote was that HSY's move was seen as rotation only, meaning it was safety-seeking money parking there. It wasn't driven by some new, exciting, fundamental growth story for Hershey itself. You're buying it because other areas look risky, not necessarily because HSY is about to, change the world. That distinction matters.
Okay, and finally, HPE, Hewlett-Packard Enterprise. This one sounds like the cautionary tale, the proof that the tech sector was struggling.
It's a perfect counterexample, really. HPE had actually looked promising earlier. It broke out into what their system calls the profit zone, which, just for context, is their internal signal for a high-conviction trading area, usually sitting comfortably above key trend lines. So analysts were initially hopeful it could make another run higher.
But it didn't last, did it?
No, the reality hit hard. It completely reset during the week, fell right back out of that profit zone. And that's just tangible proof that the broader tech pullback was real and was hitting even stocks that looked technically okay just a week before. That kind of rapid reversal really underlines the high volatility the bearish analyst B in the report's framework were warning about.
So you have this flurry of signals, WU with the short beat streak, RCI with that long but maybe thin streak, HSY breaking out defensively, and then HB just falling apart after looking good. Analyst A, the bull, would say this shows the system is working right, tracking these flows in real time.
Exactly. That's the argument. See, the system caught the rotation into HSY and WU, it flagged the momentum in RCI, and it showed HPE losing steam. But analyst B, the bear, uses that HPE reversal as exhibit A for high volatility. The sheer speed at which a stock could enter and exit that profit zone just highlights how unstable that underlying sentiment really was. You have to view every signal, positive or negative, through the lens of that bigger defensive shift.
Okay, so putting it all together, what does this all mean? Segment 4, let's synthesize this down into some actionable takeaways based on this analysis.
Right. The concluding thoughts from the analysis really focus on capital preservation and positioning for what seemed like ongoing uncertainty. 3 main points. First, Prioritize defensive exposure. That was the clearest signal. The strong flow into staples and financials means the market, or at least significant parts of it, was operating in a risk-off mode. So the recommendation was to maintain or even increase weightings in those more resilient sectors.
Okay, makes sense. Second point must be about tech, given the weakness.
Absolutely. Stay underweight technology. That was the clear message. The fragility we saw in the NASDAQ, in HPE's reversal, it's undeniable. The analysis suggested the sector needed time to consolidate, to basically stabilize and find its footing again before investors should confidently jump back in. The advice was basically, don't try to catch falling knives here. Wait for signs of renewed sustainable leadership.
And the third takeaway, it probably ties back to that RCI situation, the quality issue.
Precisely. Scrutinize all momentum signals for quality. Just because a system flags a long streak, like RCI's 14 days, doesn't automatically make it a buy. Those signals need to be backed up by solid volume and fit the overall market context. In that kind of volatile environment, chasing breakouts on low volume is just asking for trouble, very prone to sharp reversals. So quality over just the duration of the signal became paramount.
So that was the story, boiled down. From the loop market analysis for the week of September 22nd to the 26th, you had defensive sectors, staples, financials taking the lead. You had RCI with that eye-catching streak but questionable volume, and tech, shown by HPE's reset, really confirming that market polarity.
And that really leads into the final thought, the provocative question the analysis leaves hanging out there for you, the listener, to think about. This split, this divergence between defense leading and growth lagging, it can't last forever. Something has to give. So the key question becomes, how does this polarity resolve? Does technology find its footing again and rebound, taking leadership back and continuing the rally? Or does its defensive strength eventually roll over too, leading to a broader market downturn? How that divergence resolves, that's likely going to define success or failure for investors in the coming months.
Indeed, a crucial question to watch. We've just distilled the authoritative weekly discussion from the McLarty Source and D-Investment Enterprise analysis for you. Keep a close eye on those sectors. How this resolves is probably the most important factor to know.